Hi, welcome to the Wisdom Inspired Talk podcast. I am Yomi Akinpelu. Today, I'm going to be speaking about investing for beginners. I'm going to cover topics like what are stocks, what is the stock market, how it works, isn't it risky, what kind of returns can I expect, and how can I start investing today? So, let's dive right in. Let's begin with the basics. A stock is a small piece of ownership in a business. So if you buy one share of Amazon or Apple, for example, you literally own part of the company. And this is the same thing as owning a share of an ice cream shop, a cake stand, or a cafe in your local high street. It sometimes doesn't feel like that because you own a really tiny share and you feel nobody in Apple or Amazon even know that you exist. Companies like Amazon, Apple, Microsoft, Tesla, etc. offer shares of their company for sale to the public because they want to raise money or capital to invest in their businesses for growth, for expansion, and of course to generate profit for themselves and investors or shareholders. When companies offer their shares to the public for the first time, it's called an IPO, Initial Public Offering. Once a company goes public, people and organizations go to the stock market to buy and sell the stocks. This happens at the stock exchange, for example, the New York Stock Exchange or the London Stock Exchange, which is basically like a supermarket where you can walk through the aisles, browse what is available and how much it costs. Obviously, the stock market is a special type of market, unlike your local Sainsbury's or Tesco's. So you can't just walk in and start putting shares in your shopping basket. Instead, you have to use an online broker or brokerage like Trading 212, eToro, Robinhood, or a company like Vanguard, AJ Bell, Fidelity, or other online investment companies. Basically, you give them your order and they go into the stock market and do the purchase for you. A bit like your local supermarket where you order online and they deliver for you. Just like your Iceland home delivery service. Stock prices generally go up over the long term as economies grow, but in the short term, they are unpredictable and even volatile. The stock market is hard to predict because they go up and down due to many factors, including the general mood of the people, that is, market sentiment and emotions, or what is happening generally in the world. For example, when the COVID pandemic hit in 2020, the market plunged, but by the end of the year, it was on a high again. So market sentiment, what is happening in the world, affects the stock prices and the stock market. The stock market, like any other investment, has risk. And the more risk you take, the higher your returns are likely to be. But note that you won't get that return in one day. The relationship between risk and return is really important because if you invest in something speculative and risky, you might make some money quickly, but you are very likely going to lose it just as quickly. You have to consider how much money you will make relative to how much risk you take. Crypto, precious metals, individual stocks are risky investments, but they do have the potential for a higher return and, of course, huge losses. On the other hand, index funds, real estate funds have medium risk with reasonable returns, while bonds, government bonds, corporate bonds, treasury bonds, money market funds have lower risk and also relatively lower returns. So remember, in the short term, the stock market is like a casino, but in the long term, it's a money-making machine. There are various ways to mitigate the risk in the stock market, and that is by what is called diversification. The great thing about stocks is that you can buy a variety of different stocks to build your portfolio. When you have a variety of stocks from different sectors, for example, tech companies, consumer staples, cyclicals, energy, stocks from different industries, geographical regions, and different size companies, you have a well diversified portfolio and you are protected from losses. So if the stock from one company or one sector goes down, the other ones are likely to do well. If a stock from one region goes down, the others might be doing well. If some of your stocks don't do well, the others might be doing well because they're from different industries or different regions of the world. The real beauty of diversification is that it lowers your risk without reducing your expected returns. It is suggested that you should buy or hold a mixture of at least 20 stocks in your portfolio. And just by doing this, reduce your risk by at least 70%. But even better, buy an index fund like the S&P 500, which is 500 top companies in the USA, or a total market index fund, which is the stock of 3,000 plus top companies in the USA, or the FTSE Global All Index Fund, which is thousands of companies around the globe. Index funds give you excellent diversification and lower your risk. So instead of looking for one hot, elusive stock, simply invest in an index fund. Don't try to find the needle in the haystack. Instead, buy the whole haystack. And I have several other videos where I talk about index fund investing. Now, another very important concept in investing is holding your stocks for the long term. Most people recommend a minimum of 5 years, and that is because the longer you hold a stock, the more likely that it will make money for you. Research has shown that if you invest in the US market and hold your stock for a day, you have a 54% chance of making money. That's basically an even chance of making money or losing money. But if you hold your stock for 5 years, you have an 88% chance of making money. And if you held that stock for 20 years, you have a 100% chance of making money based on past performance. That is why they say that the stock market in the short term is a casino, pure gambling. But in the long term, it is a cash flow machine. By holding for the long term, you also benefit from compound interest, which Albert Einstein described as the eighth wonder of the world. Warren Buffett is a classic example of this. Warren Buffett started investing between age 10 and 11. He is now 90 years old, so he's had 80 years in the market and he's worth $86 billion. 99% of his wealth was earned after his 50th birthday, and $83 billion of his wealth was made after his 65th birthday. So investing success is not about making spectacular amounts of money quickly, but more about achieving consistently reasonable returns over the long term, because compounding does all the hard work for you, so that one day you can become a billionaire like Warren Buffett. So what is the best way for the beginner investor to start investing in the stock market? I hear you ask. The best strategy for the beginner investor, or most investors really, who don't have a clue what's going on in the stock market and have little or no time to research all the individual stocks of several companies. The best strategy, according to Warren Buffett, Jack Bogle, Peter Lynch, and other legendary fund managers is invest in an index fund. An index fund really is a ready-made portfolio which tracks a certain group of funds, like I said earlier. And in some of my previous videos, which you will find in the description below and suggested videos, when you invest in an index fund, it's like buying a tiny piece of top 500 companies in the USA just with a click. The holdings in the S&P 500 are shown in the chart. By doing this, you get a wide market exposure and great diversification, and the same general return as the market, about 8%. So, if you invested £10 a day for 45 years at a rate of return of 8%, you will become a millionaire after the period. So my recommendation would be invest in an index fund. History has shown that index funds outperform 92% of the financial professionals over the long term. And index funds are also much cheaper. So as you begin to invest in an index fund, another very important point to note is to invest at regular intervals and invest consistently. Just show up every month and invest, or better still, set up a regular standing order to take money from your current account and pay into your investment account at regular intervals. Don't try to time the market. What works with investing is not timing the market, but time in the market. The longer you stay in the market, you stay invested, the longer your money has to grow and compound for you. When you invest consistently, you'll be buying at an average cost, because sometimes you might buy high, sometimes low, but at the end of the period, you'll be buying at an average cost, and that is what is called dollar cost averaging. However, if you have a lump sum to invest, I will suggest you just invest it in one go instead of drip feeding it into the market, because the longer that money has to work for you in the market, the higher your rate of return over the long term. Just remember that it is over the long term. And don't try to time the market. I've tried it, it doesn't work. Now, the final point I must mention when it comes to investing in an index fund is the fees you pay for the fund. Index funds generally have lower fees. This can range from 0.04 to 0.1 or 0.2, but I will say go for a fund that is no higher than 0.5, preferably less. Anything higher will compound to reduce your returns over the long term. If you invested in a fund that charges you anything above 0.5, for example, a fund that charges you 1% or more will cost you hundreds of thousands over that 35-year period or so. For example, if you invested $1,000 a month over 35 years, a 1% fee will end up costing you over £400,000 or dollars in fees over that 35-year period. So it is really important to keep an eye on the fees you pay. In fact, anything above 0.5 is way too high. So the most likely outcome for an index fund investing over the long term is that you'll get the best return for the least amount of work and at the cheapest price. The only thing you have to note is that this works only long term. You won't get satisfactory results if you jump in and out of the market and don't stay invested for the long term. Compounding works when you stay in the market for the long term. Basically, index fund investing is not a get-rich-quick scheme. However, if you invested in individual stocks, you could make insane or spectacular returns in the short term, but then you could also lose your shirt. Remember, with investing, don't be rash, don't dash in and out of the market, protect your cash, or it will all be gone in a flash. And one more tip, because you've stayed till the very end of this video, make sure you wrap your investment in a tax-exempt vehicle. In other words, use a tax-free account like a stock and share ISA in the UK or 401k in the USA. And that is all for today. Thanks for watching. If you found this video useful, please like it, share it, and comment below. I would love to read your comments, and please also subscribe. In the coming weeks, I'm going to be speaking more on investing, so watch this space. Until next time, keep on growing in wisdom and maturity. Blow the cap off your capability. Be unstoppable. Be awesome. I'm cheering you on.